15,500. Our next news event here is at 10 a.m. Eastern Standard Time with existing home sales. When we look at the Fed Fund futures, we are exactly split here between July and September. And how we're relating this to price right now is that if the July meeting starts to tip, if the next Fed meeting starts to tip in as far as July goes into the rate cut, we could see the continuation of a rally. But if we get a tick here into September, then that is the perception that crude oil is still increasing, and that will drive the Fed Fund futures and the perception that the Federal Reserve will be forced to push out those rate cuts further into the future. Dollar correlations right now are in a very sensitive negative correlation here with the indices. And that negative 0.6, negative 0.5s here, backed up by the smaller time frames, creates an environment where if the dollar were to continue to weaken here, you can see here that we did break extensions and we have a traditional short above us, that if it were to continue to weaken below the 99,235 here, that we would have a rally inside of the indices. These are counter trend rallies. One could make a case in the intraday timeframes that these intraday bullish setups come from the traditionals and are going straight up in extensions. There's one little kind of hiccup in that dollar weakness narrative, though, in that the euro did not break through its extension short levels. Now, it also has a long from lows. This is essentially the lows of the week to highs of the week. But there's been no break. And so as we're going into our Tuesday morning here, if the euro defends above the 1567, we would anticipate the long still being in play on the indices and the intraday time frames, and we will keep squeezing higher inside of our extensions. When we're thinking about the gap fill statistics here as we're going into our morning, Tuesdays and Wednesdays gap fills have been the most high probability setups that we have here over the last 180 days. You can see here 76% of our gap fills have filled over the last 180 days. That is a very strong edge. There's also an 89% probability over the last 180 days and the last 90 days of a half gap fill. And so why is that important? Because when you see a reaction in the morning in the direction of, say, the half and the full gap fill, and you have 76 and 89% probabilities, we have to pay attention. This morning, we stopped at the 30 handle, which is a 50% probability. You combine that edge of the gap fill and the edge of the day of the week, and you can understand why there is a reaction at that 30 handle into the direction of the previous day's 4 o'clock close up here at the 68.0175. Now, the big question as we move forward into the morning is what happens after the fill? Because inside of our VIX support levels, you'll notice that we're still inside of these absolutely massive halfway back longs from lows of the year to highs of the year, the lows of the year to highs of the year. And these extensions, they have to continue. We have to keep going straight down in extensions this week. Otherwise, we validate VIX support. And so what that really kind of puts a perspective on is this, is that if we get to the half and the full gap fill, and the VIX is just bouncing off of a trading hours low as we go. This stream continues at eMiniAddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.